The announcement by the Kenya Revenue Authority that will be seeking to get third-party information about potential taxpayers from institutions such as banks and Mpesa sent down shivers to many Kenyans who felt that it was an intrusion into their privacy. And with the legal backing of the same having come into force this month, KRA says there is no cause for alarm, promising that the activity will not be a witch hunt of potential tax cheats.
We are not saying that we are targeting the telecommunications sector. We are not targeting banks and financial institutions. We are talking about taxpayers. And it will depend on sector which are not complying. And of course, there is the significance, the importance of flexibility for the commissioner to do this. Is for the good of the Kenyan citizen.
With Kenya having signed and continuing to sign tax treaties with various countries to fight off tax evasion havens, the authority is urging those who have income and assets held overseas to take advantage of the current tax amnesty by December this year.
A legal confirmation or assurance that you will not, if you take advantage of the tax amnesty. But there are conditions attached to it. You should not be subject to an audit at the time you're applying. Tax amnesties normally have a start and end date. So, under the double tax treaty, this is also an instrument which is going to help tax administration follow up on cases of transfer pricing or citizen, resident who are having assets overseas and are not making full declaration in their tax returns.
KRA says the introduction of 10% excess duty on cosmetics has so far had no impact on their prices.
Prices did not necessarily drop after exempting cosmetics from excess duty. And therefore we ask ourselves, did this policy intervention achieve its objective? No. So how do we fix this gap? To reintroduce excess duty on cosmetics for purposes of harmonization and also for revenue mobilization.
Other notable tax incentives that came with this year's national budget include the Special Economic Zones tax incentives, hospitality industry tax benefits, and the new tax regime rates at a flat rate of 10% for rental income.
A special VAT treatment to exempt garments and leather manufactured in the EPZ has been passed in the Finance Bill 2016. This is a deliberate move in the name of the tax incentive. There are questions coming up that is it fair to the textile industry? Whether fair or not, I think they are deliberate moves taken by the government, and this is what's supposed to be looking to going forward so that the objective is met in the long run. Even developed jurisdictions use this instrument to spur economic growth, manufacturing, and exports.
Nicholas Ndwati, News Hour Business.